Imagine owning a slice of oil rigs in Texas, wind farms in the North Sea, and the pipelines that keep everything moving without picking a single stock. That's the power of an energy ETF, and in the next few minutes, I'll show you exactly how they work, what to watch out for, and a simple step-by-step plan to get started. Stick with me to the end for a practical checklist you can use before you click Buy. First, what is an energy ETF? Think of it like a playlist for the energy world. Instead of betting on one song, one company, you buy the whole playlist with one click. An energy ETF holds a basket of energy-related companies, oil and gas producers that drill and explore, refiners that turn crude into gasoline and jet fuel, pipeline operators that transport it, service firms that provide the tools and expertise, and renewable energy players building the future with solar, wind, and storage. You trade it like a stock in a regular brokerage account, but under the hood, you get instant diversification across many names. Why do investors use them? 3 big reasons. 1. Diversification. Energy can be a roller coaster. Rather than guessing the next winner, you spread risk across the sector. 2. Convenience. Researching dozens of balance sheets and commodity cycles is a full-time job. An ETF wraps that work into a single product. 3. Potential income. Many energy companies pay dividends, and funds can pass that income through to you. Some ETFs reinvest dividends automatically, others pay them out in cash. The exact policy is in the fund's documents, but the takeaway is simple. You can get broad exposure plus the chance for income along the way. Now, let's talk flavors, because not all energy ETFs are the same. Broad sector ETFs bundle the biggest integrated oil and gas companies alongside equipment, services, and midstream operators. Subsector ETFs slice the chain: exploration and production for people who want more torque to crude prices, midstream for pipeline toll collectors with cash flow focus, oilfield services for the picks and shovels of the industry, and refiners who profit when the spread between crude and finished products is favorable. Then there are clean energy ETFs, focused on solar, wind, and related tech. They can be more volatile, but they align with long-term transitions and policy tailwinds. You'll also find global versions that include companies outside the US, which can diversify currency and regulatory exposure, and equal-weight funds that avoid putting most of your money into a few giants. How do you choose among them? Start with the index or strategy. Every ETF follows a rule book. Some track a well-known index that selects and weights companies by market size. Others use screens, like excluding coal, capping any single stock's weight, or focusing on dividend quality. Read the fund's What We Track in the summary and scan the top 10 holdings. If 2 companies make up a third of the fund, expect those stocks to drive your results. If the fund tilts toward midstream, you're more sensitive to volumes and toll-like cash flows than oil price itself. If it leans into explorers, you're signing up for higher sensitivity to commodity swings. Next, look at cost and liquidity. Expense ratio is the annual fee the fund takes. Lower is generally better, all else equal. Liquidity shows up as trading volume and bid-ask spreads. Even if a fund is great on paper, a wide spread adds hidden cost every time you trade. Check the average spread in your brokerage and the fund's net asset value versus market price. In normal conditions, the price should stay close to the value of the underlying holdings. Then, evaluate tracking and structure. Tracking difference is how well the ETF keeps up with its index after fees and frictions. Over a year or more, you want that gap to be small and consistent. Most US-listed energy ETFs hold the underlying stocks directly and are designed to be tax efficient, but always check distributions and your local tax treatment. If you're outside the US, the fund's domicile can affect withholding taxes on dividends. Risks? Be honest with yourself here. Energy is tied to global growth, geopolitics, and commodity prices. A surprise OPEC decision, a warm winter, or a sudden recession can move prices fast. Policy also matters. Subsidies, carbon pricing, and permitting timelines can help or hurt subsectors. Interest rates trickle through as well. Higher financing costs can weigh on capital-intensive projects like renewables and pipelines. Sector ETFs are concentrated by design, so they can swing more than broad market funds. That's not a bug, it's a feature, but it means you should size your position with care and avoid overexposure. All right, let's get practical. Here's a simple, repeatable way to approach energy ETFs. Step 1. Define your goal. Are you looking for steady income, higher growth potential, or a balanced core exposure to the energy ecosystem? Income seekers often consider midstream-heavy or dividend-focused ETFs. Growth-tilted investors may prefer exploration and production or clean energy. If you're building a core position, a broad sector fund might be best. Step 2. Pick your structure. Choose one broad fund as your anchor, and then add a small satellite in a subsector you believe in. For example, 80% broad energy, 20% clean energy, or 70% broad, 30% midstream for income. Keep satellites small, they're seasoning, not the whole dish.
Step 3. Check the facts. Read the fact sheet and top holdings. Confirm the expense ratio, average spread, and distribution schedule. Make sure the index method aligns with your thesis. If your conviction is electrification, a fund that's 90% integrated oil might not be the fit you think it is. Step 4. Plan your entry. Instead of going all in, consider dollar cost averaging over 4 to 8 weeks. Energy headlines can spark big moves. Averaging smooths your entry price and reduces regret. Step 5. Set rules before you buy. What would make you add? What would make you trim? Maybe you rebalance when the position grows beyond 10% of your portfolio. Maybe you pause new buys if the fund's premium to its net asset value gets stretched. Write the rules down and follow them. A quick example to make this real. Suppose Alex wants exposure to the energy transition but knows the sector is volatile. She chooses a broad energy ETF for 8% of her portfolio to capture integrated majors, pipelines, and services. Then she allocates 2% to a clean energy ETF to lean into long-term growth. She checks fees, keeping the weighted average below a reasonable threshold, verifies the top holdings aren't overly concentrated, and sets a rule to rebalance if energy crosses 12% of her total portfolio. She invests in 4 equal installments every 2 weeks. Once a quarter, she reviews tracking difference and dividends and skims the fund's updates for methodology changes. With those simple steps, she has a thoughtful plan anchored in process, not headlines. A few pro tips to wrap this up. Don't chase last year's winners. In cyclical sectors, leadership rotates. Balance your energy ETF with other parts of your portfolio, technology, healthcare, and bonds, so one theme doesn't drive your entire outcome. If you want to express a view on oil prices specifically, remember that a broad energy ETF is not the same as a crude oil futures fund. Stock-based funds are influenced by margins, costs, and hedging, not just spot prices. And always check how dividends are handled because that affects cash flow and taxes. Here's the promised checklist you can screenshot before you buy. Goal clarified, index method understood, top 10 holdings reviewed, expense ratio and spreads checked, tracking difference within comfort, dividend policy known, entry plan set, rebalance rules written. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. Energy ETFs turn a complex global machine into a single tradable ticker. They're like owning the whole power grid in your portfolio, pipes, platforms, panels, and all. So you can participate in the world's need for energy today while positioning for the changes coming tomorrow. If you found this helpful, stick around for more clear, practical guides just like this. And remember, keep it simple, stay diversified, and let your process, not the noise, do the heavy lifting.